Have you ever felt overwhelmed by the thought of investing, especially as a beginner? You're not alone. The world of investing can seem complex and intimidating, but it doesn't have to be. In today's video, we'll break down the top 8 smart investing strategies for beginners that can help you build a solid foundation for your financial future. Whether you're starting with a small amount of money or want to learn how to invest for long-term wealth, these strategies will make investing easier, more accessible, and more rewarding. Stick with us to discover the smart, simple ways to start investing confidently. 1. The core and satellite approach. One of the best strategies for beginners is the core and satellite approach to investing. This strategy helps you balance stability and growth by dividing your investments into 2 categories, the core and the satellite. For your core investments, you'll want to allocate around 80% of your money into a diversified, low-risk asset like an S&P 500 index fund. The idea here is that you're building a stable, long-term foundation for your portfolio. The S&P 500 includes the top 500 companies in the U.S., offering you instant diversification and reducing your risk exposure. The remaining 20% is used for your satellite investments, which are higher risk but have the potential for higher returns. These could be sectors you're passionate about, like renewable energy, AI, or cryptocurrencies. The satellite portion allows you to invest in areas that interest you, keeping you engaged in your investment journey, while still maintaining the stability of your core investments. This approach allows you to capitalize on growth opportunities while ensuring that the majority of your money is protected with a diversified foundation. 2. Dollar cost averaging DCA. If you've ever hesitated to invest because you were waiting for the perfect time to buy, you're not alone. Many beginners struggle with market timing, fearing they'll buy at the wrong moment. That's where dollar cost averaging DCA comes in. Dollar cost averaging is a strategy where you invest a fixed amount of money regularly, regardless of the market price. DCA removes the emotional stress associated with market volatility. It also helps to mitigate the risk of making poor decisions based on short-term market movements. By investing consistently, you take advantage of the market's fluctuations, gradually building a position in the market without the pressure of timing the market perfectly. 3. Fractional share investing. Another great strategy for beginners is fractional share investing. In the past, buying a single share of blue-chip companies like Amazon, Google, or Tesla could cost hundreds or even thousands of dollars. But thanks to platforms like Robinhood or Charles Schwab, you can now buy fractions a share for as little as $1. This makes it much easier for beginners to start investing in high-priced stocks without needing a large initial investment. Fractional shares allow you to diversify your portfolio across different stocks, industries, and sectors, even if you don't have thousands of dollars to invest. This strategy also allows you to add exposure to companies that you believe in but can't afford to buy full shares of just yet. Over time, these small investments can grow, and as your portfolio grows, you'll be able to purchase full shares with the profits you've earned. 4. Index fund, set and forget. If you want to take a hands-off approach to investing, index funds are the way to go. An index fund is a type of mutual fund or ETF that tracks a broad market index, such as the S&P 500, providing you with exposure to hundreds of companies within a single investment. By investing in an index fund, you're essentially buying a small piece of the overall economy. The set and forget approach is simple. Choose an index fund, set up automatic contributions, and let it grow over time. This strategy is ideal for beginners who want long-term growth without the hassle of picking individual stocks or actively managing their portfolio. Historically, index funds have outperformed most professional stock pickers, thanks to their diversification, low fees, and consistent performance. Since index funds track the performance of a broad market index, they're inherently diversified, meaning your money is spread across many different sectors and industries. This reduces the risk compared to investing in individual stocks and helps protect your portfolio during market downturns. With minimal maintenance, index funds allow you to set it and forget it, letting the market do the work for you over time. 5. Target date funds, TDFs. If you're looking for an automated investment strategy with zero maintenance, target date funds, TDFs, are an excellent choice. These funds are designed to be a one-stop investment solution for retirement. When you invest in a TDF, you choose a fund with a target date that corresponds to your retirement year, e.g., 2050 or 2060. TDFs automatically adjust their asset allocation as you approach your target retirement date. In the early years, they are more heavily invested in stocks, which offer growth potential, and as the target date approaches, the fund becomes more conservative by shifting toward bonds and other safer investments. This gradual shift reduces risk as you near retirement, helping you protect your investments from market volatility as you need your funds more. TDFs are perfect for beginners who want zero maintenance and prefer not to actively manage their portfolio. These funds do the hard work for you by automatically adjusting your asset allocation, allowing you to focus on saving without worrying about market changes. 6. Tax advantage growth. One of the smartest moves you can make as an investor is to take full advantage of tax advantage accounts before opening a taxable brokerage account. Tax advantage accounts, such as an IRA or 401k, offer significant tax benefits that can boost your wealth-building efforts. With a traditional IRA or 401k, contributions are tax-deductible, which reduces your taxable income in the year you make the contribution. In contrast, with a Roth IRA, you contribute after tax money, but your withdrawals in retirement are tax-free. The tax savings, whether upfront or upon withdrawal, act as an immediate return on your money that a standard brokerage account can't match. Maximizing your contributions to these accounts allows you to grow your wealth tax efficiently, while also benefiting from the power of compound interest. By using tax advantage accounts, you can avoid paying taxes on investment gains every year, allowing your investments to grow at an accelerated rate. If you're in your 20s or 30s, it's never too early to start investing in tax advantage accounts to make the most of these long-term benefits. 7. Rebalancing your portfolio. As markets shift, your portfolio may no longer be aligned with your original risk tolerance. For instance, if stocks have done well and bonds have underperformed, your 80-20 stock-to-bond ratio may have shifted to 90-10. Rebalancing is the process of adjusting your portfolio back to your desired asset allocation by selling some of your winners and buying more of the underperforming assets. Rebalancing your portfolio ensures that you're not overly exposed to a particular sector or asset class. It's essential to check your portfolio at least semi-annually to make sure your investments reflect your risk tolerance and long-term goals. By regularly rebalancing, you keep your portfolio on track and avoid potential risks that may arise from market fluctuations. Rebalancing also offers the opportunity to buy low and sell high. By selling portions of your winning investments and reallocating funds into underperforming assets, you ensure that you're not riding the market's highs and lows. This consistent process helps protect your wealth and keeps you focused on long-term growth. 8. Invest in your human capital. When you're in your 20s or 30s, one of the best investments you can make is in your human capital, your skills, knowledge, and education. Investing in yourself through certifications, degrees, or skill-based courses can dramatically increase your earning potential, which in turn fuels your ability to save and invest for future. Rather than solely focusing on passive investment strategies, consider how you can improve your career prospects. Whether it's learning new skills in data science, AI, or digital marketing, increasing your earning power will provide more capital for all your other investments. Additionally, advancing your career or gaining specialized knowledge can help you secure promotions, higher-paying jobs, and business opportunities. The value of investing in your human capital is immeasurable. By gaining relevant certifications or skills, you can increase your income and accelerate your wealth-building journey. And there you have it, the top 8 smart investing strategies for beginners. From the core and satellite approach to investing in human capital, these strategies can help you build a strong foundation for long-term financial success. Investing doesn't have to be complicated. It's all about finding the right strategies and staying consistent. If you found this video helpful, don't forget to like, share, and subscribe for more tips on personal finance and investing. Let me know in the comments which investing strategy you're excited to try first. See you in the next video.